Uh, Today we will start discussing financial statement and analysis of financial statements, right? Which is very important because in any business, why we do business is to get the profits, right? So when we are evaluating a business as a credit person, you need to know to identify the strengths, weaknesses of the business through finance. Because end of the day, if we don't have profits, we won't be able to repay our loans, right? Therefore, financial performance is a key function. Maybe we say that companies are managed very well. But if profits are not there, no point having very good HR system or computer system. Right? So our aim here is to understand the financial statements and to learn how to evaluate the financial statement. Because financial statement is like our horoscope. It will show you everything. As a credit person, as a banker, our job is not to look at the T accounts and all those things. Our job is to interpret the information which is shown by the financial statement. You need to know how to create a P&L and balance sheet. On top of that, you should be able to evaluate those things, right? So, based on financial statement, we evaluate the past of a company, present situation, and the future financial. We tend to project the future. That is the important. We look at the past, we evaluate the present, and we project the future, right? Because we can't predict the future without knowing the past. Just people. It is like a building where building stands on the foundation. All our action, all our way of getting the things done depends on our past. So, financial statements also, we have any business, we have to look at the past because past will repeat and any trend. Like if I say today I can't pay even 10,000 rupees, but I will be able to pay 100,000 in the future, we can't trust those kind of things. Those are dreams, right? Because everything is gradual. Maybe 10%, 15% turnover growth we can expect, but not 200%, 300%. So we need the past, we evaluate the present, and we project the future. By evaluating a financial statement, we look at the weaknesses of a company and the strengths of a company, right? Because when we have weaknesses like obsolete stocks or bad debt or loss making weaknesses, profitability and balance sheet, those things will show you the weaknesses, whereas the strengths also. Strength means the ability to or competitive edge which they can build on. Primary tools would be the financial statement and comparison of ratios. So we will have three basic financial statements. Firstly, we have the P&L, profit and loss statement, or we call it performance statement currently, right? So P&L is, if I give you a brief structure of a P&L, we have turnover, or we say sales, right? Turnover sales. This sales can be broken into two things: cash, credit sales, right? Cash or credit sales, okay? Then when we talk about credit, we need to know, so that is the percentage of cash sales, percentage of credit sales. Then we need to know what is the period we give for credit. Credit period, right? So this one, this entire thing is called terms of trade, TOT, right? What is your cash sales, what is your credit sales, the percentage, and how long you give. 7 days credit, 30 days credit, 45 days credit.
Is there any connection between this one and credit turnover ratio?
Yes. In order to do that, we need this, right? So, any valuation you speak to a customer, this is your starting point. Right? So, this is called terms of trade, right? Trade, percentage, then the period. It can be 7 days. Normally it is 7 to 14, 14 to 50, 14 to 30, 30, 45, like range. It is a range, not a specific day, because different customers will have different risk profiles, right? Therefore, for one person we may be giving 7 days, another person 10 days, 14 days. So it is a range we look at, right? Always it has to be a range. So this is turnover. Then we have something called direct cost. Direct cost. We have three items under this, main three items. What is direct cost? Direct cost is the cost directly changing with turnover. Turnover comes from price into quantity. Right? If you are selling pens, how many pens? Right? Direct cost are the cost which will change, which will vary with the quantity you sell. Right? First item is raw material. Right? Second one is direct labor. Third, power. Right? So if you are a manufacturer of this pen, the plastic you need, the ink you need, all those things are direct cost. Because if you produce 10 items, you will need 100 grams. If you produce 100 items, you need 100 grams. If you don't produce anything, you don't have a cost for raw material. This labor is the direct factory labor. It's not the manager or the supervisor. It is the factory labor. If you pay, we assume that factory workers are paid per piece. Right? If they produce 10 pieces, they will get 100 into 10 or whatever. If they produce 50, they will get 100 into 50. Like that, it changes with this. We assume that in this scenario, we assume that whatever we produce, we sell. Right? It is for the easiness. Right? Otherwise, you have a opening balance and closing balance on all things. Then power, again, it is for the factory, the production, not for the office. And this power is direct power which relates to this. So these things are called direct cost. Right? Then, so if you take this one as A, sum of this as B, you have gross profit. Fit, O we call it GP, O we sometimes call it contribution. Right? If it is C, A minus B would be C. Right? A minus B. turnover minus direct cost would be gross profits. Right? Then we have what is called overheads. Right? Overheads are the cost which does not vary with the production, with the unit we sell. Whether you sell or not, you need to incur this cost. Right? If a factory is there, you have a factory manager, without even producing anything, you need to pay the factory manager. Security guards are there. Even if you close the factory, you need to pay the security guards. Right? So, any cost which is not linked to the quantity you sell is called overheads. We have three types of overheads: admin overhead, marketing, selling and distribution, and finance. Right? So, anything you pay to a bank except for the interest, it goes here. Anything you pay to a bank except for interest, it goes here. Then, selling and distribution, marketing related expenses we cover here. Then all other expenses which does not directly relate to the sales, which will not change with sales, goes onto admin, like security, janitorial, factory, office staff, all those things goes here, right? So this is the overhead cost. Then when we add this as D, we have something called profit before interest and depreciation, PBID, profit before interest and depreciation. Right? We take that as E, then E equals C minus D. Right? E equals C minus D. Gross profit minus OH. Right? Now you can say, okay, I'll come to that. Then I'll start from here, PBID. After that, we have, which is D, we have interest and depreciation. Right? Interest and depreciation. Interest is twofold: term loan interest and short-term interest, long-term interest and short-term interest. This is term loan plus leases interest. This is POD, short-term revolving facilities, all short-term facilities. Right? Then we have depreciation. All the depreciation we can edit here. Right? But accounting standards allows you to put depreciation here, the factory depreciation here, and all other depreciation here. Right? It is allowed. Right? So, for the easiness of doing everything, we can take everything here. Right? If someone gives you a account statement with depreciation at those points, you can subtract those things and bring it here. Right? Then it is clear. And depreciation. Then we have something called operating profit, which is called OP. Right? That is D. If it is this one E, this will be F. F equals D minus E. Right? D minus E. This one,
So you said that PBID is equals to E, then there are
PBID is P. Sorry, I have made a mistake. This is E, then this is F, then this is G, E minus F. Right? Okay. So this one, PBID is our cash profit. That is the last point we have as a cash profit. Because depreciation is not an actual expense. It is only a provision. Right? We allocate part of our profits to replace our fixed assets. Right? It is only allocation. So we call this as the cash profit. And this is the cash profit. PBI. So you have profit from operation, so we call it operating profit. Then we have other income. Any income we generate over and above, or like any income which we generate which does not relate to the main income source. Like if I'm evaluating a printing shop, right? Printing press, we say all printing related incomes goes here. Right? All printing related income goes here. If you print posters, income will go here. If you print boxes, income will go here. But if you will have offcuts on the boards, you cut the board, then you will have smaller pieces. You sell that. That is not your main business. Your main business is printing. That off-cut selling is something out of your main business. That income will go here. That is called other income. You have a big factory, you are renting out a smaller part of that factory to someone. Right? So that is not your main source of income. That is something additional. Then it will go here. If you are in the business of renting, if you are in the business of renting out spaces, it will go here. Right? So any income which is generated out of, not from the main source of business, will go there. Right? Then we can stop it here saying net profit without considering tax. We can stop the P&L here saying net profit. Or what happens if we are not stopping here? Then profit before tax. We call it PBT. Right? Profit before tax will come now. Right? So if this is G, this will be H, and this will be I. I equals G plus H. Right? I. G plus H, because this is a income. Then you have tax. Then you have profit after tax. PAT. PAT is your profit after tax. IT. Then this will be J. This will be J. And this will be K. So it is I minus J. Right? This is your profitability statement or performance statement.
Profit after tax is equal to profit before tax
minus X. Okay.
Sir, another doubt that operating profit equation is profit before interest and depreciation.
Operating profit, yes, profit before interest and depreciation minus interest and depreciation.
Interest
Right? So, this is your performance statement. Right? This is how your business has operated over a specific period of time. P&L is produced for a month or quarter or biannually or annually. So it is for a period. P&L is prepared for a period, not for a date. Right? It can be monthly, quarterly, biannually, or annually. Right? Normally our P&L date is 31st, 3, whatever the year. Right? So this is right. So then we write 21, 22. Or we write 21, 22. Right? What does this mean? This means P&L period. Yeah. 21 to 31st, 3, 22. So last is the last period and this is the beginning date. Right? So this means that if someone shows you FY 2021, that is for the year ended 31st March 2021. Right? So this is how we write these things. These are standards. Then I will stop this. Hope everyone has written down if you want, and you have brought forward profit for the year. Here, dividend minus carried forward profit. Right? There's another note on like this. Brought forward profit, that is from the previous year. This is what is the figure. Right? For the year profit, then if you declare the dividend, you reduce that. Brought forward profit plus this minus dividend will be your carried forward profit. Brought forward profit plus this year profit minus any dividends, you will have the carried forward profit. Right? This is called reserve calculation. Reserves, profitability reserve, P&L reserve calculation. Right? I'll tell you where it is placed. P&L reserve calculation. Right? I give you 1 minute. If you want to write it down, you can finish. right? So P&L we did. Then we go to the financial position or balance sheet. Normally we call it balance sheet. Nowadays we call it financial position statement. Then we have fixed assets, right? P&L is produced for a period, but financial position is done for a date. Right? It is for a date. It is a snapshot on that date. Right? Fixed assets are assets which has useful life more than 12 months. Any asset which has a useful life more than 12 months. Land and building. Then we have machinery. Then we have equipment. Then we have vehicles. Right? Then we have work in progress. Right? There are two types of work in progress. So I wrote one type here. Land and building. Machinery, like if you are into manufacturing, you will have big machines. Right? All those machines are going under machinery. Then you will have different tools, computers, fax machines and all those things. Those things will go, ancillary items will go under equipment. Then vehicles, you know what it is. Work in progress is any items which we have taken for a construction of a building or construction of a factory, machine, like the fabrication of a machine. Those things which does not, any stock which does not relate to the trading item or small spare parts we don't put, any inventory relating to these three will come here, right? Not vehicle spare parts, so these two basically, right? So any inventory which, okay, we say we are doing an expansion in the factory. So you have brought cement and everything, it will go here. If the factory is half built, it will go here, right? It will not go there, right? We are talking about a factory which has 10,000 square feet and we have constructed only 5,000 up to now and remaining, still we are on the construction mode, then that value we have spent will come here. The day we finish the building, oh, it will go there, right? Till the time we finally complete or say, okay, we are constructing only up to this point, it will remain here, otherwise it will go there. Like condominiums, you are constructing condominiums, right? Then till you finish the manufacturing construction, it will remain here. Once we finish, it will go there. Right? So this is called gross fixed asset. Gross fixed assets. Right? Then we will have something called less accumulated depreciation. Accumulated depreciation. That is, P&L, we have the depreciation for that period. only, right? Year on year we add that and we accumulate that because this is at cost. This is at cost, right? Year on year, whatever we provide to the P&L, you have to accumulate and reduce from this, right? So this is accumulated. Then we have net fixed assets, right? If this is A, this is B, this would be C equals A minus B. Gross fixed assets minus the accumulated depreciation would be net fixed assets. Right? Then we have something called investments. If you have a fixed deposit which is 2-3 years to mature, we go there. If you have investment in share market, which we keep for the maturity, longer tenure, it will go there. Right? It's not short term. So we take this as D. Then we have current assets. Any asset which can be converted into cash within 12 months period is termed as current asset. Any asset which has a useful life more than 12 months is called fixed assets here. Any asset which can be converted to cash within 12 months period comes under current assets. Mainly inventory, debtors, prepayments. If you have given in prepayments, advance payment, that will come. Then we have cash, right? This is cash, right? Inventory, stocks, our trading stock. Then you have debtors, which created by the credit sales. Then we have our cash in hand and bank. If it is short term, you can have it here.
Can't we put that into investments?
If it is more than 12 months, 360, you can put it here. If it is not kept for like FDs also, if it is more than 12 months, you put it as investment. If it is 3 months, 6 months, you can put it as current assets. Any asset which will be converted to cash within 12 months period goes here. Anything above that goes here. In practice, all those treasury bills and all those things we put it here. Right? But the theory says anything above 12 months has to go to investment. Below 12 months, you can have it on the current. Right? Then we have, this is one way of writing a balance sheet, right? Current liability. Any liability which need to be settled within 12 months is called current liability. Any liability which needs to be settled within 12 months period. Mainly credit sales, creditors. Right? When you give credit to the market, when you are buying raw material also, you can get credit. So they are all creditors to the business. Then you will have accumulated accrued expenses like light bill, water bill, which we pay 1 month in arrears. Right? That can come here. But normally, mainly, we have this short-term facilities, PODs, TODs, and all the short-term facility. Any banking facility which need to be settled within 12 months period. Right? These are the main items in current assets and current liabilities. Right. Then we have net current assets or liabilities. E minus F. Current assets minus current liabilities is called net current assets or current liabilities, so we call it working capital as well. Right? Current assets minus current liabilities, which is called net current assets or current liabilities, or we call it working capital as well. That is the portion of current assets which has been financed by long-term funding. Right? Because we have reduced the current liabilities from current assets, that means other has to finance by long-term funding. Right? Then we have total assets, which is equal to C plus D plus G, so it is H equal this. Total assets equals net fixed assets plus investment plus net current asset or liabilities. If it is if your current liabilities are higher than the current assets, then you will have net current liability, which is a bad situation. Right? So this is your asset side of the balance sheet. Then we will go to finance by. Share capital, reserves, net worth, is 10 plus equals I. Net worth is equal to I. Right? Share capital, like these two words are used only for limited liability and above companies. Sole proprietor and partnerships, we don't use the words share capital or net worth. We use sole proprietor's capital or partner's capital. Right? We don't use this for sole proprietorships and partnerships. Right? Share capital plus reserves will become net worth. Then we have term loans and leases. Term loans and leases. If it is IJ, then we have total capital employed. That is K equals I plus J. Right? K equals I plus J. This total capital employed is net worth plus term loans or leases. Right? So, end of the day, H should be equal to K. Then the balance sheet will be balanced. And total assets should be equal to total capital employed. Right? total assets equals total capital employed. For online participants, do you have any questions? Text box is open. If you have any questions, you can ask me so I can answer those things before going forward. If no questions, I will continue. Right. Right. So you can remember that we did the profit brought forward and carried forward. That P&L is linked to the balance sheet from the profit carried forward, brought forward. Sorry, this is carried. That reserve is this point. P&L and balance sheet linked from this point, right? Then, so this is one way of writing your balance sheet. Other way of writing your balance sheet is fixed assets, current assets, total assets. Then current liabilities, long-term liabilities, total capital employed. This is net worth and term loans and leases. This is the other method of writing a balance sheet. Right? You have fixed assets plus current assets, that's total assets. Liabilities, you have current liabilities, long-term liabilities, which is net worth plus long-term. Basically, this part comes to the liability side. From this point, we finish the asset side. Long-term asset and short-term asset. Short-term liability, long-term liability. Right? So we can write both the things together differently because this is working capital. That's why I have written this way. Both are allowed. Right? So P&L is linked to the balance sheet through this point. Right? That carried forward reserve point comes in. Right? Then we have something called cash flow. Cash flow is linked to the balance sheet from this point. Right? P&L is produced on accrual basis. That means you don't wait till the cash comes in. We have two types of accounting: accrual basis accounting and cash basis accounting. Accrual basis means when you sell, we don't wait till money to reach us. We take it as a sale. When we say cash basis, when you get the cash only, we recognize as a sale. Right? So sometimes we do cash basis because only when we get the normally P&Ls are done at accrual basis. Balance sheets are done on cost. Balance sheet is done at cost, not on the value. Right? Land, I have brought it for 10 million rupees. Today's value is 20 million. We don't consider 20, we consider 10. If you want to consider 20, you need to have a revaluation. Then you need to have a revaluation reserve. Like that, it's a complicated. Normally what we do, it is balance sheets are done on the cost, P&Ls are done on accrual basis, right? In order to know the cash inflows to the bank, business and the outflows, we produce cash flow statement. Cash into the business and cash out from the business. What is the liquidity? What is left in the business, right? Like from profit before interest and depreciation. That is our last cash profit, right? Then we deduct interest, loan cap, because in P&L we don't consider loan capital, right? That is going to the cash flow. In the P&L we don't consider dividend pay. That is a cash out. We consider it to the cash flow, right? So similar to reserves, cash also we do brought forward, cash flow the year and carry forward, right? That is linked through this cash, right? P&L and the cash flow is linked through balance sheet. Sorry, balance sheet and the cash flow is linked at the cash position, right? Cash, is it clear? Right? Cash flow is linked to the balance sheet through cash. P&L is linked to the balance sheet from reserves, right? That's two things. Then how does the business operate? Initially, you will get cash. How? From this one, or this one, or this one, you will get cash. Right? That cash will reflect here. Right? That cash will reflect here. Right? Then, from this cash, we will buy inventory. Inventory are three types: raw material, work in progress, and finished goods. Right? If I am a shirt manufacturer, if the shirt is being manufactured, that is booked under finished goods. Right? Cloth and material and buttons and yarn and everything goes as raw material. When the shirt is finished, ready to sell, it goes as finished. Right? So initially we get cash, then we use cash to get inventory. When we sell, we get debtors. When we sell, we create debtors. When we collect the debtors, we will get cash. Right? When we have cash, we go and settle the creditors. Right? You can buy raw material on credit, then you will get creditors. If you buy cash, you will not get creditors. Right? When you have cash, you settle this. Short-term facilities, you settle. Again, when you need to buy goods, you use this for cash, then you start the cycle again. You buy credit, go here straight away, then you start the cycle. Right? So always this is the day-to-day run of the business. This one and this one. That is called the working capital. So managing inventory, debtors and creditors is called working capital management. Managing debtors, inventory and creditors is called working capital management, which is the funding requirement for day-to-day operation. Right? So always we say all current liabilities are settled by liquidating current assets. Right? We sell inventory, create debtors, collect debtors and pay creditors or settle ODs. When you settle a OD or creditor, you can retake. When you retake, again, this will go up. Right? You are not putting any burden to the P&L, profitability of the business. So, we are playing with the cash here, creating this, settling it. Once you settle, you can again reutilize and buy. So, always current liabilities are settled by liquidating current assets. Only the interest portion will be settled by the P&L. Profitability, only the interest portion will go. Capital portion of the current liabilities will be rolling over. Right? However, long-term loans, interest portion reflect at the P&L, capital portion will be at the cash flow. Right? So, because what is the meaning of a long term? You take it for a specific period of time, and over that period of time, you settle it and finish it off. You can't reuse the term. Right? That. So, this is P&L and balance sheets. Right? Cash flow is different. We are mainly to cover this. Cash flows also can be done subsequently, but this is the main two steps. Right? Cash flow is linked from that cash position. P&L is linked from the reserve position. Right? So this is the position of a firm, asset minus liabilities, book value of the firm, revenue minus expenses, net income or net profit of a firm. This is what I have been discussing for the last 45 minutes. Basically, this is few months lectures on a normal. Like if it is accounting, this is a few months lecture. I just put the essence of it. Right, balance sheet shows the financial position of the firm, asset liabilities on a particular date. Income and earning statement represent the results of operations. Right? So, what is operation? It is the manufacturing and sales. Operation, revenue, expenses, profit or loss of the accounting period for the period. Then statement of cash flow provide information about the cash inflows and outflows outflows from operating, that is the manufacturing part, financing, that is the short-term, long-term investments we do, right? Activities during accounting period, right? This is the normal way. I'll give you briefly on cash flow as well. I'll write it down. This is one way of doing a cash flow, but this is not the accounting way. This is easy way which we have developed. For banking purpose, this method is more than sufficient. For my entire life, I have been using this way, not the standard accounting way. Cash in, right? PBIT, profit before interest and depreciation. Then we have equity. Then we have term loans. Then we have short-term loans. Equity, leases, anything. Right? These are the only ways cash will come to the business. Equity, term loans, short-term loans, and from operations. This is the operating operations. This is finance. This is investment. Right? This is cash ins. Cash outs are out. Right? If you have any capital expenditure, whichever does not capture under the P&L. Cash outs are whichever does not capture under the P&L. That's all. Right? Then tax, dividend, term loan capital, lease capital. Right? Capital. Interest. Right? Term loan interest, short-term loan interest. Right? Whichever has not been captured at the P&L level. Right? Capital expenditure, if you have invested on a building, you have not captured it in P&L. So we go and put it here because money has gone out of the business. Up to PBID, all the operating expenses has been covered. So we go straight to the PBID. Right? If you are not doing anything, so you can put other income here. Right? Because we are getting cash, so you can put it there. Capital expenditure, then taxes, we stopped at PBID. Dividends, we don't consider the P&L, so we can put dividends here. Capital repayments, we don't put it to P&L, we put it here. Interest, because we stopped at PBID, short term and long term interest. This is cash out. Right? Cash surplus or deficit equals, if this is A, this is B, C as A minus B. Similarly, cash brought forward, cash surplus or deficit, cash carried forward. Cash carried forward. This is going to the balance sheet as cash. Right? This is cash. It is an easy way derived by the normal cash flow statement. Right? We have all the things: operating, financing, and investing activities. Right? PBID operating, financing, investing. This is investments. This is outflow from operations. Dividend from the operations. Right? Capital, all finance. Right? So this. Then we have the cash brought forward, that is cash from the previous balance sheet, cash available for the specific year would be cash surplus or deficit. So brought forward plus deficit would be carried forward. That is going to the next balance sheet. So balance sheet is linked to the cash flow from cash position. Right? Any questions? Yes. Question is, when we considering account receivable in balance sheet, we have to deduct provision to get the net account receivable is it, right? So if we write down the hardcore receivables, like we create debtors, and sometimes we say we can't collect. So normally 10% goes back. So we provide for that. We reduce that amount and show it as net receivables, right? You can always have a provision. Those are technical terms and those are finer accounting, right? Always it is the net position we will be talking here, right? Clear more? Alpha, sorry. Is it clear? Okay, right? Anyone else who have issues? Right. If not, we will go ahead. So this is the financial statement we need, and financial statement analysis, tearing apart, like when we analyze, we take different relationships, different logics, so we tear apart and analyze it, right? Relationships. Who analyze? Internal users and external users. Internal users are the managers, supervisors, board of directors. They will evaluate the operations, the performance of the management. By this, for supervising and controlling purposes, we need the P&Ls and balance sheet. External users are people like us, bankers, regulators, creditors, all those people will look at the business. Prior to giving money to this business, we want to evaluate. We know to know where the business stands, where was it, and what is it today. Then only we will decide for the future. Right? Planning, evaluating external users, past performance and current financial position, and making prediction on future profitability and solvency of the company, as well as effectiveness of the management, right? If your stocks are maintained well, then it is a management efficiency. If you have better profit, is management efficiency. Year on year, you are increasing the profitability. Then it is the management. So we speak about management through numbers. So these are the things in a audited statement. We have statement, financial statements, notes to the financial statement, because on the P&L we don't show everything as you asked me earlier, like receivable statement notes will be there. There you say gross receivable and provision for bad debt and net provision. Net provision will come to the P&L. Letters to the stockholders, auditors report, independent report, right? When you have audit statement, if the auditor says it is unqualified, right, that means it is very good. Everything is transparent and according to the standards. If it is qualified, that is a bad remark. In auditor statement, don't Normally when it is qualified, that's good. Unqualified, that's bad. But in audited statement, if it is qualified, that is bad. That means they sign subject to some conditions. That is the meaning of qualified. Unqualified means everything is good, we are just signing it off. Newspapers, those things, information can be taken. Method of financial analysis. We have these methods, right? Horizontal analysis, right? Horizontal analysis means we take a P&L or balance sheet. We take a P&L first. We have year 1 and year 2. We take one P&L item and evaluate how it has changed in rupee term or percentage term. Whether it has gone up, gone down, what. So, 2 periods, 1 item evaluated, right? If I erase this, right? We say P&L, turnover, direct cost, raw material, labor, power, gross profit, right? You have financial year 20, 21, 21, 22, right? If it is a horizontal evaluation, we have X1, X2. So we will see at X1 minus X2, what is the change, right? If it is, we say capital X, this is the change, right? We divide this by X1, this is the percentage change. 2 things, absolute term change and percentage term change. Is X capital X divided by X1 into 100, this is the percentage change, right? That is horizontal analysis. Horizontal analysis, right? Horizontal. 2 periods, 1 item analyzed, right? That is horizontal analysis. Vertical analysis means Y1, Y2, Y3, like that, Y4, we said. We analyze or represent each item as a sum of a total item. Like we analyze Y1 divided by X1. What is the percentage? Y2 divided by X1. What is the percentage? Y3 divided by X1. What is the percentage? Representing that is called vertical analysis. Each balance sheet item or P&L item will be represented as a percentage of a major item, right? That is vertical analysis, right? Before going further, I will show you that. This, right? Using comparative financial statements to calculate rupee or percentage changes in a financial statement item from one period to the next, right? From this to this, rupee or percentage, right? Then we go to vertical. Using single financial statement each item is expressed as a percentage of a significant total. Direct cost is a percentage of sales. Labor cost, raw material cost as a percentage of sales. Labor cost as a percentage of sales. Gross profit as a percentage of sales. Right? So this is for single financial statement. Then we are considering single financial statement. Each item is expressed as a percentage of significant total. This is the significant total. Each item represented as a percentage of significant. All income statement items are expressed as a percentage of sales. If it is balance sheet, total assets, we represent every item as a percentage of total assets. That is vertical axis. Then common size statement. Next one is common size. Now, when we talk about P&L, balance sheet, or cash flows, whatever, we talk about absolute terms, rupee terms. When it is common size, we are not talking about rupee terms, we are talking about percentage terms. Financial statement that shows only percentage and no absolute rupee amount is called common size. I show you a common size statement. Right, this is a common size statement. See, this one. Everything is represented as a percentage. Right? We use this kind of statement for two things. Firstly, it is easy. Everything is percentage, so straight away you can see any changes. Right? Secondly, when you are comparing a large company with a medium or small company, if it is rupee terms, you will not be able to compare. One company has billions of sales. Other company will have millions. Right? But which one is more effective? Which one has better controls? We don't know. If you try to compare billions with a million, we can't compare. But if it is percentage, it is not value. It is only a percentage. So, billion company will have 5% profit margin, whereas million company will have 10% profit margin. So, it is better. Right? Better. So, in order to avoid this size difference, we use percentage terms. Right? Two things. Firstly, in order to change the avoid the size difference. Then the other one is to have an easy access, easy representation of this. Right? P&L or balance sheet to be represented by percentage terms is called common size statement. Right? Then we go to trend percentages. Right? Under the trend percentages, what we do, we evaluate one P&L or balance sheet item over a period of time. Turnover, year 1, year 2, year 3, year 4, year 5. What is the X1, X2, X3, X4, X5? Absolute term it is. Right? So you can evaluate in absolute terms or percentage terms how the this is your base year, how the turnover has changed. Right? percentage wise, x1 divided by, sorry, x2 divided by x1, x3 divided by x2, x1, x4 divided by x1. Like that, you can calculate the percentage. Shows changes over time in given financial statement item. Can help evaluating financial information of several years. How the turnover of a business change over large period of time. Maybe 5 years, 10 years, like that. Cost, how the cost has increased. Right? There was a percentage I showed you. Then ratio analysis. It is the expression of logical relationship between items in financial statement of a single period. It is a logical representation, right? It is on a single period. If you compare this, then it will become horizontal analysis, right? Ratio analysis is the logical relationship between financial statement items and items of single period. Remember this single period. Whatever the ratios you calculate, it is for a single period. So, other thing you have to remember is, if you are calculating a ratio using balance sheet items only, you can just use the same figures as on the balance sheet. If you are calculating a ratio using P&L items, you can just take the items and do the calculation. However, if you are creating a ratio using P&L and balance sheet items both, P&L items and balance sheet items both, P&L figures can be taken as it is, but balance sheet figures you need to average and take. Right? If you are we do a calculation, you take one item from P&L, we say X is P&L figure, Y is balance sheet figure. If it is X divided by Y, if the ratio comes as X divided by Y, this is P&L figure, this is balance sheet figure, right? X divided by Y is the ratio you are talking about, right? X you can take as it is. Y, you need to take Y1 previous year, Y2 current year. This is X2 right? Same year is this. So we have take 10, right? Year 1, year 2. Then we need inventory. We say debtors. Year 1, this is X1, X2. Year 1, year 2. Right? You are calculating the figure for year 2. Right? So turnover you take as it is, which is X2. Right? Balance sheet figures, you don't take X2, you take Y2, Y1, Y2 divided by 2, average. Right? You are creating a ratio using P&L figures and balance sheet figures. This is the figure, these are the figures you have. P&L, first year X1, second year X2. Balance sheet Y1, Y2. You are creating the figure for Y2, year 2. So you take X2, which is the year 2 figure as it is, but for the balance sheet item, you won't take Y2 alone. You take Y1 plus Y2 divided by 2. You need to take average figure. Why you need to take average figure? Balance sheet is for a date. but P&L is for a period, right? P&L is for a period, balance sheet is as at date. In order to avoid this timing difference, timing gap, we take P&L figures as it is for a period. Balance sheet, we take average figure. Beginning of the year and the end of the year. We divide by 2. So we take an average. So we do that for avoid the timing difference. Right? If you don't do it, these ratios will change slightly. Not a big change, but it will change slightly. Right? So normal practice is to take P&L figures as it is, balance sheet figures on average. Whenever we are using P&L figures and balance sheet figures together to create a ratio. If you are creating a ratio is a logical relationship only, right? We are creating a ratio using P&L figures only, you take the figures as it is. If it is only balance sheet figures, you take the figures as it is. You don't do anything. But if you are using P&L figures and balance sheet figures together to create the ratio, then P&L figure as it is, balance sheet figure average, right? Because two different time differences. Right. Then I will show you a horizontal analysis from this example. Right, these are the current assets and current liabilities, all these things. Calculate rupee change current year on the base year. So this is the base year, this is the current year, right? Parameter තමයි base year, right? Base year. Since we are measuring amount of the change between 18 to 19, the rupee amount becomes rupee divided by base year would be the percentage change. Right? So this is your base year 23,500, current date is 12,000. Change is 11,500. So horizontal analysis means one item compared between two periods. 11,500. This is the calculation. Then you have percentage terms. 11,500 divided by the base year figure into 100, 48.9. This is the change. So horizontal analysis can be done on amount wise, rupee terms, or percentage terms. Right? These are all these things. The same things different. This P&L, earlier what we did is a balance sheet, same item. So 480,000, 520, the difference is 40,000. 40 divided by 480 is 8.3. Cost of goods sold, direct cost, 315 to 360, 45,000 increase. 45 divided by 315, 14.3% change. So, two periods, one item, how it has changed. That is called the 45 divided by 360. 350. Base. Yeah, 350. This is the basic. Right? This is current year, this is the base. So, we calculate the percentage from the basis. Then we go to vertical analysis example. So it is, what is vertical analysis? we represent each balance sheet to P&L item as a percentage of a significant total, but it is for a specific year. Okay. This one. This is the cash position total. So 30,000 divided by 380, adding of everything 387, which is 8% of total assets. 100,000 divided by 380 is 26% of total. So this is the vertical analysis. If you compare these two, then it is a horizontal analysis. Right? Right. These can be mixed. Vertical analysis is one single period. Each item is represented as a percentage of the significant item. This is the significant item. Right? Each item is represented as a percentage of significant item. This is 100%. See? This to 100%. Right? Now, after you do this, if you compare, okay, this year it was 8%, now it has increased to 17%. Right? 19% increase, 9% increase. That calculation is a horizontal combination of horizontal analysis and vertical analysis. Right? So this is a vertical analysis. If you compare this way, it is horizontal. Right? Base year. Now we come to trend percentage. Trend percentage. One balance sheet item or one P&L item evaluated over a period of time. What is the trend of sales? What is the trend of gross profit? What is the trend of direct cost? Right? So it says this is the base year. Right? First year 1, it has gone to 1991. Year 2, it is 2118. So, in order to get the percentage change here, 1991 minus 1820. That is the rupee change. When you want to get the percentage change, rupee change divided by base year. Second year, 2112 minus 182 divided by 1820. Right? Then you will get the percentage change for this year. 2244 minus 1820, you will get the rupee change here divided by 1820, then it is percentage. Right? So you will get. Easy way is 1991 divided by 1820. Then you will get into 100, which is 109. That means 9%. This is the change. This is the percentage change. Right? If you do this lengthier calculation, you will get 9%. 9%. If you just divide, you will get this one. This is 16%. This is 23%. This is 33%. Right? Easy. You just straight away divide. So minus 100 is the actual ratio. Right? From the base, because this is 100. 100, this is 130. So change is 32%. Right? This is a lengthy way. So when you are doing calculations and working, you have to find easier ways. Right? Otherwise, you have to follow 2 steps to get this. Straight away you divide and subtract 100 to 1. Right? If it is 232, you subtract only 1. 132%. right? Okay. So it is 100. We are starting from 100. In exams or in your life, you are running against the time, right? Always create your own ways of doing, right? Always. Make a hadala, it was make a bedala, you don't have time. Straight away divide it. If it is 100 below less than 200, just remove this one. If it is above 200, remove the 1. Okay? That. So this is trend percentage analysis. So we did horizontal analysis, we did vertical analysis, we did trend percentage analysis, and I discussed common size statement. Common size statement, since you were not there, common size statement is a financial statement represented not in rupee terms, in percentage terms. And my other handout you can see is everything is represented as a percentage of a significant group, right? This is the trend percentage. When you plot that, you will get this, right? Then we come to ratios. Ratio is a logical relationship between items. That's all. Nothing else. You can create any number of ratios. You can term it, name it, and you can create it. Right? You yourself can create ratios. That's fine. Only thing you need to give a name to it. Right? But we have general ratios. Ratios can be expressed in 3 different ways. This is the ratio 1:2. That means per rupee of something, we have 2 rupees. This is the ratio. For each unit of one item, we say each unit of current assets, we have 2 units of current, so each unit of current liabilities, we have 2 units of current assets. 1:2. 1:3 means per each unit we have 3 units. 1:1.15, each one unit we have 1.5 times. Right? So that is one way of writing ratios. If you write this, 1.55:1, right? That is, each item will be covered by 1.155 times. If you write this one also, same way. We have not written this one. When you write this way, it implies that you have this. Right? Is each item of 1 unit will cover by 1.5. So you can write that way, or even you write this. We write times. When we write this, we write times. When we write this, we don't write times. Right? So that is easy. Then you have percentages. Right? This is ratio given in one way. Then the second mechanism is percentages. Gross profit margin. Gross profit divided by turnover into 100. Then it comes as percentage. Right? It comes as percentage. Change divided by the base into 100. Then we write something rupees. This is, we have only 2 ratios which we calculate for listed companies. Earning per share, EPS is earning per share. Right? This is very limited usage. Right? These are the main usage methods we use for ratios. Right? This is a joke. Using ratios and percentages without considering the underlying cost may hazardous to your health, not health. Need to incorrect conclusion. right? Without knowing why it is, if you start predicting or discussing, you will go wrong, right? You have to, like, when you calculate a ratio, I'll give you a small example. I did a calculation for agriculture spare parts importer, right? His turnover was 200 million annum or something like that, and he had roughly 2 years worth stocks, but still he wanted money from us, right? So we calculate the ratio, it came to 700 odd days. Then I asked him, why is you have stocks for this much? Why do you want more money? Then he started saying, no, there is a huge stock which I can't sell, which is called obsolete stock. So still he is keeping it in the stocks because he don't feel like throwing it. He has purchased each item at 400 rupees. Now he can't sell it. Everyone is asking per kilo at 400. So he don't feel like selling. So he's just keeping. So if I have taken that ratio without knowing what is behind it, I'm making a wrong decision. So always you need to discuss and see what is behind the ratio. That's the meaning of this. Right? Using ratios and percentages without considering the underlying cost may leads to incorrect conclusions. Right? I could have gone to a correct conclusion if I didn't ask the customer. Right? Categories of ratios, we have few categories, main categories, you can have subcategories. Liquidity ratios indicate company short-term debt paying ability, current liability settlement ability, that is liquidity. What is your liquidity? How much money you have to pay day-to-day run? You may be having a vehicle, you may be having a house. If you don't have money in your pocket, you can't run. You can't live day on day. Right? Liquidity is that. You have 1,000 rupees in your hand, but when you want to spend 20 rupees and no use for 1,000 rupees, no. You can use 1,000 and do it. That is a different thing. So always what we assume is we are not force selling anything. We can easily sell. I can say, okay, take the 1,000 rupees and give me the 20 rupees something. Water bottle. Right? That is not it. I need to be able to pay the exact amount, and when I want money, this 10,000 rupees, I want 1,000, keep it and give me 1,000. Right? So that is not the way we do business. If I am giving you the 10,000 rupee value item, if I can get at least 9,900, I am fine. But if it is at a very discounted, then it's not a business. Right? It is a charity and our inability. So liquidity ratio is the ability to pay the short-term borrowings. It can be bank borrowings, it can be creditors and any liability which needs to be settled within 12 months. Then we have equity ratios or long-term solvency. We call equity ratios, gearing ratios, solvency ratios, whatever the names. There what we look at is how our business has been funded, long-term funded. So relationship between the debt and equity. I didn't tell you something at that point. I missed to tell you that. In the balance sheet, we are financed by Buy side, share capital, reserves, net worth, then term loans, leases, total capital. Right? This is called, this addition, this is called equity capital. This is called debt capital. Right? The owner's funds. The whatever the money belongs to the owners of the business is called debt capital. Whichever is borrowed long term, we need to repay is called debt capital. Debt. Equity and debt. Long term loans and leases. Right? So this long term solvency ratio, equity ratio, gearing ratio, whatever the name you use, it is to find out the relationship between this and this. This two. Out of the funding, how much is equity, how much is debt, long term. Right? We are looking at long term only. We are not looking at the short term. Right? So because short term goes to liquidity. This is long term. Higher the funding from a big bank, long term funding from banks, higher the risk of a bank. Financial risk would be higher when the long term funding from financial institutions are high. Why? Whatever you earn, major portion will go there. Businesses will not grow. It will go in this way. Businesses will not grow like this. It will go this way. Right? It is up and down. If your debt commitment is very high, so you will not be able to pay. If you keep a debt commitment low, even if this business drops, you are still stable as a bank. Right? So that's why we always calculate a debt equity ratio or gearing ratio and see how much of money the investor has brought in. How much is ours? So normally what we do, maximum we go for 60% out of the total capital invested. Bank will put 60%. At least 40% need to be brought in by the owners. Right? You need. That is to balance this. O and to get the commitment from the customer. When the major portion is given by a bank, why should I want? I won't lose anything. If I fail, bank will lose. I will lose a small amount. It will won't hurt me. That is the importance of a security. Security is a what? Psychological advantage over and above the borrower. Something valuable to you is with me. If you don't pay, I will take hold. Then you will have a commitment towards paying. That's what we discussed last week. Right? So all these things are related. Very practical. Don't think this as a like standard accounting. Then it is accounting is one of the boring subjects in the world. But this is very practical. As a banker, you have to look at the practical side. Not the accounting, T or how will happen the T. For date, I don't know T accounting. In my life, I have done T accounting only in my A levels. Right? But this is very practical thing we are talking. As a banker, your job is to interpret accounts, not to construct. You need to construct, but not to go into that in detail thing and construct, but you can construct. Right? That is credit. That's called credit, not accounting. Profitability says related income to other variables. All P&L figures, what we did, gross profit margin, net profit margins, those are profitability. There are other things like ROE, return on equity. Whenever there is something called return, then it is profit. Return on equity, return on assets, profit divided by something, then it is return. Right? Market test, that is the listed company, earning per share, and all those things. So these are the main items. In between, you will have efficiency ratios, a debt collection period, data collection period, stock turnover period. Those things are called efficiency ratios. Right? So these are the ratios we are going to talk. Current ratio, as it is, account receivable, number of days, inventory turnover, equity, net margin, let's say return on equity, earning per share, price earning ratio. These are the ratios we need to discuss.
Do we get this ratio calculation or expression?
Sometimes they have asked. But if you are a credit person, don't think as exact. Okay? The biggest problem we face is in the banking industry. When we sit in the, like I have told the institute as well, people comes and say, I am fully qualified in banking. You ask one question, you're gone. Don't think about it. Think the knowledge. Then you will take, because end of the day, you are going to work. Right? You can say I have this and that, everything. I'm telling everyone, whoever listening online as well. I can have all the degrees in the world. But if you can't do it practically, this is what has happened to the country as well. We are not practical. We have all qualifications, PhDs and everything, but we are not practical. So we don't know the ground. So, yes, be thorough. If you want to go for credit, you need to know the ratio calculations. Right? Because we evaluate, like whenever you discuss with the customer also, your aim is to identify the P&L and the balance sheet of a customer. Right? Then you need to do all kind of ratios and see whether what he is saying and what the P&L and balance sheet is saying is the same. If it is not, he may be lying, or he does not know actual scenario. Right? Our job is to find out the essence of it, because we are lending others money. Right? Yes, we may get, may not get. Normally they used to ask. Right? For a credit officer, this is redundant. If you want to go into credit, you need to know. So I face many times people come for the interviews and I'm fully AIB, right? Then one question on working capital, AIB gone. Then I asked them, have you gone for classes? No, sir, we don't go to the classes. We just go through the past papers and we pass. That destroy the reputation of the industry, reputation of the institute, and reputation of the qualification. ඉතින් අතන කියන්නේ වැඩක් නැහැ නේ EID තියෙනවා කියන උනාට මේක දන්නේ. At the end of the day, you should be able to sit on the seat and write this. Right? So, in your young age, learn, qualify, but put it to practice. Not just add letters behind your name. That's all. So, in the general run, if you can't work, what's the point having qualification? So qualify yourself, but be practical and put your knowledge to work and see. Right, these are the tests we are going to do. These are the ratios we are going to do. Right? So next week will be my last class to you, and there will be a new lecture coming after that. Right? So I will try to I will finish this one and I will finish working capital before leaving. Right? So these are the example we use for this. Take a printout and work on this. So this is the cash. You have why you have beginning of the year and end of the year. That is to calculate average. Right? Right. Working capital. Working capital is current assets minus current liabilities. Right. Fixed assets, gross fixed assets, current assets, current liabilities. Current assets minus current liabilities is called working capital. Right? We will do detail. This is the easy way of doing it. Current assets minus current liabilities is working. That means liquidity. Right? Out of the current assets, the asset which needs to be converted to cash within 12 months period, how much is funded by long-term funding? That's the meaning of this working capital. Current assets minus, that means 65,000 of current assets can be converted to cash. You have to pay only 42,000 during that year. So you have enough cash of 23,000. Right? So this is liquidity. Because you don't need to pay. It will be with you. When you pay this one, you can retake that. Current liabilities are settled by liquidating current assets. You convert inventory, you sell inventory, you create debtors, you collect debtors, then you will get cash. By that cash, you settle creditors or short-term loans. So you can retake the short-term loan to buy inventory, or you can take creditors and take inventory. See this one. Inventory, debtors, cash, this side, creditors, and short-term ODs. This is current assets and current liabilities. Current liabilities. Where we start with cash, cash will be high. We buy inventory, inventory go up, cash comes down. In order to get cash, we have this has to be up, right? From here, you will get cash. Right? Here you will get cash. Then from you use the short-term POD, you get cash. From cash, you buy inventory, then cash level will come down. Right? You sell credit, your inventory will come down, creditors will go up. Right? End of the period, you collect debtors, your debtor levels will come down, cash will go up. When you have enough cash, you settle this. Right? You take creditors, credit purchasers, you get inventory. Right? Credit purchasers, you get inventory. You sell on credit, you get this and it will come down. You collect, then cash will go up. You settle the creditors, they can reduce. This is a cycle. Current liabilities are settled by liquidating current assets. So current liabilities are buckets. Take a bucket. You can use it, you can take it. Settle it, reuse it. Right? So working capital is current assets minus current liabilities. That means the remaining part is the working capital. That is the funds used by long-term funding to finance the current assets. So we don't need to settle this much urgent. You have enough cash for 23,000 rupees, which you don't need to settle in. That 23,000 has been funded by equity or long-term fund. Right? So this is the liquidity position. Your company's liquidity position. Because this you need to settle short term. This you don't need to settle short term. This is called working capital. Right? But when you term it out, you say working capital is the fund required for day-to-day operation of the business. Right?
Capital is the excess.
That is the liquidity. When we talk about liquidity, working capital is the funding requirement for day-to-day operations. Right? You need basically managing these three items. This is called working capital management. Managing inventory, debtors, and creditors is called working capital management. These three items are the main items in working capital. You have to be very, very thorough with working capital if you are a credit officer. Then we have current ratio, right? The first ratio under liquidity is current ratio. We calculate current ratio by current assets divided by current liabilities. That shows the coverage we have for current liabilities. What is the coverage the current assets will give for current liabilities? See that? Current liabilities is this. right? Current asset is this. This has to be settled by liquidating these items. How easily can we liquidate? Think about a scenario where you have to settle 100,000 current liabilities, right? Current liabilities, PODs, and creditors. You have to settle 100,000. You have 200,000 inventory debtors together. You have 200,000. Though we have inventory, we will not be able to sell in a hurry. Or you will have to give it on discount. There may be problems on inventory, right? So, I am the one who has given current assets, liabilities to the company. I am a banker, I have given a TO, right? I look at current assets to say, okay, they have 200,000 worth current assets. So, even if we sell 50% of it, I am covered. I have to collect only 100,000. They will have 200,000 current assets. Even if they face problems to sell, and even if they sell 50%, I'm covered. Then I'm happy. Right? But next company, they have only 120,000. They owe me 100,000. Can I be that safe? No. Because if they can't sell, or if they have to force sell, they will not get 100,000. We are on the margin. That is called the current ratio. What is the coverage I have from the current assets? The practical side of it is what I explained. Otherwise, it is only a number. Right? I have creditors who are the people who look at current asset, current ratio, creditors, and short-term funding people. Because we want to know how much are we covered by the current assets. Because current liabilities are settled by liquidating current assets. You should be able to liquidate, sell to pay. If I have a good coverage, I'm happy. If I have a marginal coverage, I'm at risk. Example is, I have to collect 100, I have given, creditors has given 100,000 worth of raw material. When they look at the balance sheet, they say 200,000 inventory debtors and cash. Right? So, I can have a peace of mind. Why? They have 200,000, they have to pay me only 100,000. Even if they sell 50%, I can collect my money. I have 100,000 to collect, but they have only 120,000 in current assets. In that kind of a scenario, I will not be able to collect. Right? So that is the use of that. So you can, in a business, when a customer comes to you, you need to calculate, if they are asking for short-term facilities, you need to calculate the current ratio and see whether they have enough cash to cover us. So normally current ratio should lie above 1.5 to 2.5 range. Right? Then we are safe. Even if they can't sell, part of it we will be able to collect the money. Right? So current ratio should be above 1.5, not more than 2.5 as well. When it is 2.5, it is good for the current traders. Right? But it indicates a wrong management decision. Creditors means what? I'm playing with, the company is playing with others' money. Creditors means companies playing with others' money. They are operating using their money, not theirs. Right? Because we have given raw material free, not a big change in the price. Good. I come to you, give me material, I will pay you after 2 weeks. So you have to bear your cost. I'm not going to pay that. If I pay cash and buy, I will start paying OD interest. Right? So always you need to play with these two. If it is above 2.5, what does this mean? Comparing to this one is small. Long-term funding has been used to finance the current assets. That is the meaning of this. So current ratio equals capital X divided by Y. If current liabilities are Y, current assets are X, then X divided by Y is current ratio. Right?
That is less than 1.5%.
That is risky.
For the company.
For the current liability holders. In one way, it is risky for the company, they will not be able to pay. But for us, short-term lenders and providers of current liabilities, it is risky. Yes. Excessive. Right? That means we say, okay, 300,000. This is current assets. X. Right? Why current liabilities is 100,000. So you have excess funds of 200,000, which has been financed by what? Because current liabilities has funded only 100,000. This has been funded by equity or long-term loans. Right? Always short-term funding is cheaper. Right? PODO short-term funding is cheaper than 5-year, 6-year loan funding. Why is that? I showed you this last week. This time versus risk. Time versus risk. Right? So always, even if you want to get a 5-year deposit, you have to give a premium. 5-year loans are at a higher rate. Short-term loans are at a lower rate. Okay? Nothing. Yeah. So that is liquidity basically. We call it working capital and liquidity. Yeah.
So the liquidity is basically funded by long-term funds.
This is funded. This is the part funded by long-term funds. Long-term funds are costless. Right? So if you are a manager, you need to be efficient. That is not what we expect from a manager. You have to manage the business efficiently to improve your profitability. So this is risk averse. This is risk averse. Right? If the current ratio is less than 1.5, current ratio, then it is a risk-taking company. They are taking risk. Slightest mistake, they will not be able to pay the creditors. Right? So liquidity. Right? For us, the country, we don't have liquidity. That is the issue we have. Nothing. We don't have dollar liquidity in the market. If you are not clear, ask me. I don't have an issue. I'll explain. Because this is very, you need this. Working capital, you need. I'm not talking about working capital, I'm talking about the current ratio. Right? That means how much of this is covered by this. Right? But bigger coverage also not good. It is good for the creditors. But as for the management, we discussed management efficiency.
Other than for liquidity.
Yeah.
Meaning that can invest.
Yeah. Long-term funding should be used for those things. So wherever possible, get it free. Creditors is free. So use them. No, I don't want any risk. I am putting all my money. Then it's not business. Business is taking risk and making profit. Right? Why we do jobs? We don't want a risk. We have a stable income. We try to manage with it. Business people will have higher profit because they take a risk. Right? Risk return trade off. Higher the risk, higher the return. Lower the risk, lower the return. So this our entire, when I started, I don't know you were there, our life depends on this. This trust. Our entire life is on that. Supply and demand. That's all. Purely our life is supply and demand. Even your marriage is supply and demand. Right? Your education is supply and demand. Your living is supply and demand. Right? Why I am here today? Because there is a demand for my knowledge. That's why I am here. Why you are here? You want to grab your knowledge and increase your demand. Because there is a short supply of talent. So it is supply. Nothing. Right? So current ratio is this. What is the coverage current liability holders will have from current assets? It should be in the range of 1.5 to 2. Some people say 1.2 to 2, but it is 1.5 to 2.5 is the safe and comfortable range. Right? Otherwise 1.2, slight mistake, you will go down. Then measure the ability of the company to pay the current debt as they become due. We are talking about the capital. Interest comes from the P. So that current assets is this 42. 65,000 current assets, current liabilities 42. Okay, yeah, sorry. See how it has written 1:1.5. So 1 unit of current liabilities will be covered by 1.5 times of. If you don't write this, it is 1.5 times. Right? Remember that. So you can write 1.5 times or 1.55 is to 1. Right? Both are the same. Quick ratio is current assets minus easiest way is quick ratio, easier way, layman way, current assets minus inventory divided by current liabilities. Right? That is the layman's way. assets minus current liabilities, sorry, inventory divided by current liabilities. To calculate that also okay. Right? Right? Why is that? That will be lesser than current ratio. Inventory is the hardest to sell. In an urgency, selling inventory is the most difficult. When you write the balance sheet, after fixed asset, we write inventory. Balance sheets are written based on the liquidity. Not that we just write. That is written on the liquidity of the asset. Ability to sell and convert it to cash. That's called liquidity. Right? So hardest to sell is inventory. Right? Therefore, we reduce, so at the acid test quick ratio, we reduce the current assets by the inventory amount and divide by current liability. What is the coverage current liabilities have from the liquid current assets? If we can have this one in the range of 1.2 to and above, then it is safe.
It's
2
1.2 and
above.
until
So no cap in the same. Other cap is 2.5. It is not cap. These are just practicalities. Because current assets are current ratio is we are trying to cap at 2.5. So this one also, if it is less than that, even 2%, that's good. Right? You don't have a cap there. Right? The only thing what you need to look at is, if this is high, the quality of debtors. Right? You need to know the underlying costs. With big amount of debtors. It is high, it is big amount of debtors. What is the HMDC? What is the data collection? So everything linked. You can't take anything in isolation. If this is big, you will have to jump and see what is the quality of your data. Right? Is the data turnover period has changed?
As a banker, when we not that short, rather than evaluating the current ratio, later we can go to the just it's more
That is more safe.
removing the
Yeah, that is safe. That is safe. So what we do the calculation of current ratio. Then we say that we can't ignore the inventory. There is a possibility of selling. Then we look at the asset base. If it is because standard is current ratio. Then we go for firstly the current ratio, then to the asset test. Asset test, if you even have 1.1 to 1.2, 3, that's good. Then we have another thing called cash ratio. Cash divided by current liability. Maybe 0.6, 0.7, even above 0.5, that's good. That means what is the coverage we have from liquid cash? But people won't keep much liquid cash in the business. If you have very liquid credit balances running accounts, then it's also not good. You are not using money wisely. Right? You are there to earn money. Right? Full credit balance means they are not utilizing creditors, so sure. Like maybe they are utilizing creditors very wisely. Right? Then you will have to say, okay, large creditor, because you have cash, that means you are not paying creditors. If you are not paying creditors, also bad. Because they will stop one day. Then you will lose the business. Right? So it is a give and take call. Right? So we have current ratio, quick test, acid test, quick ratio, both the same, and cash ratio.
0.5.
Maybe 0.5. Even if you have 0.5, that's good. But you won't have 0.5. Yes. Companies, if you are managed well, they will not hold much cash. Yes, they want to convert the product into sales and get good. Right? So these are the liquid. So here what I said is the layman one. Current assets minus inventory divided by current. But if your question gives you details, you have to take this. Quick assets are cash, marketable securities, account receivables, and current notes. Your treasury bills and commercial papers, smaller ones, short term. So you add those things and divide it by this. Instead, if the question gives details, you add these items and divide by current item. If the question does not give details, only the current assets, inventory, and this thing, then current assets minus inventory. Right? This is the final form. That is the layman form. Okay. So with this, we'll stop for the day. Whereas third ratio, that also write on that way. Third ratio is this. I want to go detail on this. So we'll stop here. Next week we'll finish this, and I'll start. I'll finish the working capital as well next week in my last class. Right? Okay. Thank you.